Welcome to The Explainer. Today, we're diving into the rigid, highly detailed, and honestly pretty fascinating accounting standards surrounding earnings per share, or EPS. You might think EPS is just a simple standard number you pull off a stock app, but there's actually a massive engine of rules running in the background. We're going to transform those dense reporting standards into a clear roadmap, helping you uncover a company's true profitability by looking at exactly how the math is done. Here's our roadmap for today. We've got 4 main pillars to cover: the rights issue bonus, retrospective adjustments, presenting earnings per share, and finally, crucial EPS disclosures. Let's get right into it. Starting with Pillar 1, the rights issue bonus. All right, to really grasp this, we need to know what a rights issue actually is. Think of it like a discounted VIP ticket offered exclusively to existing investors. Because these new shares are almost always priced lower than the current fair value of the stock, the transaction includes a built-in bonus element. And for an accountant, that bonus element immediately complicates our basic EPS math because it changes the value of the shares without a corresponding change in actual resources. Now, what's super interesting here is the gap. The gap between the actual fair market value of a share in the open market and that discounted rights issue price being offered to existing shareholders. That gap represents the exact bonus element we just talked about. Accountants simply can't ignore it. They absolutely must adjust for it to keep historical EPS numbers accurate and comparable over time. So, how do they adjust? Well, we have to find something called the theoretical X-right fair value. I know, it sounds intimidating, but it's really just a logical recipe. First, you take the aggregate market value of the shares right before the rights are exercised. Next, you add the fresh cash proceeds coming in from that exercise. Finally, you divide that blended total by the new number of shares outstanding immediately after the issue. You're basically just blending old value with new cash to find a true post-issue baseline. And that calculation brings us straight to the rights factor. You just take the fair value per share immediately prior to the issue and divide it by that theoretical baseline we just figured out. This creates a really crucial multiplier. You then apply this multiplier to all ordinary shares outstanding prior to the rights issue. Why? To ensure your historical EPS perfectly reflects the new reality of the company's share structure. Okay, moving on to our second pillar, retrospective adjustments. In financial reporting, timing is literally everything. Imagine a scenario where a company's share structure changes. Let's say they do a share split after the reporting period ends, but before the financial statements are officially approved for issue. The standard is incredibly strict here. The per-share calculations for those statements and any prior period presented must be based on the new number of shares. You essentially have to practice financial time travel and reach back to adjust the historical data. So whether the number of outstanding shares increases because of a capitalization, a bonus issue, or a share split, or if it decreases from a reverse share split, you adjust retrospectively. Did you find an error or change in accounting policy? Yep, you adjust retrospectively. It's a hard rule designed to sync up timelines, so investors are always comparing apples to apples when looking at year-over-year EPS. Plus, the fact that you made these adjustments must be fully disclosed. All right, with the math and the timelines perfectly synced up, we hit our third pillar, presenting earnings per share. Here is the golden rule. You cannot bury the numbers you don't like. Accounting standards strictly dictate that an entity shall present basic and diluted earnings per share with equal prominence for all periods presented. On top of that, it has to be clearly separated for profit or loss from continuing operations. Equal prominence literally means you can't put the flattering basic EPS in giant bold font and hide the diluted EPS in tiny text. They stand side by side. No hiding. Now, there is a tiny exception for simplicity. If basic and diluted EPS happen to be exactly equal, sure, they can share a single line in the statement. But if a company has a discontinued operation, they must distinctly disclose the basic and diluted amounts per share for that specific operation. They can do this right on the main statement of profit and loss or spell it out clearly deep in the notes. And here is a rule I absolutely love for its brutal honesty. Companies do not get to hide bad news. The standard states that an entity shall present basic and diluted earnings per share, even if the amounts are negative. That's right. If the company is bleeding money, they must clearly display that painful loss per share. Transparency is mandatory, for sure, in good times and in bad. And that brings us to our final stop, Pillar 4, Crucial EPS Disclosures. Entities basically have to lay all their granular math out in the notes. Consider this your financial detective's toolkit. They must reconcile the exact amounts used as numerators back to the profit or loss, and they have to do the exact same thing for their denominators, the weighted average ordinary shares. They also have to expose the what-ifs, meaning they must list contingently issuable shares that were excluded because they are anti-dilutive, and describe any significant share transactions that happened after the reporting period. The goal? Making sure absolutely nothing remains hidden from the investor. But what if a company wants to get a little creative? Say they want to show amounts per share using a unique reported component of profit and loss that isn't actually required by the standard, maybe just to highlight a specific metric they're super proud of? Well, the standard builds a massive firewall against manipulation here. They can totally report a custom metric, but they are bound by strict steps. First, they have to calculate it using the standard weighted average shares we've been talking about. Second, they have to disclose it with equal prominence in the notes. Third, they must clearly indicate if this basis is before tax or after tax. And finally, they have to provide a full reconciliation back to a standard reported line item. You simply cannot mislead investors with alternate math. So I'll leave you with this to ponder the next time you open up a stock app. Are you just blindly trusting that single shiny EPS number on the screen? Or are you ready to act like a true financial detective, dig into the disclosures, understand those weighted factors, and uncover what a company is actually worth?
Today, we're embarking on a pretty fascinating investigative journey into modern Indian accounting standards. We're going to put on our detective hats and examine the fine print, the hidden clues, and the really critical rules that shape how corporate financial health is truly measured and reported. So, how exactly do you count money that comes with a catch? Sounds a bit like a riddle, right? But honestly, this is the central mystery we deal with in modern accounting. It's not just about counting the cash sitting in the bank today. It's a much more complex puzzle of figuring out when to count the money, whether you actually get to keep it, and what invisible strings might be attached to it down the line. Financial reporting is all about navigating these exact uncertainties with precision. Okay, let's dive into this. Here is our game plan for today. We'll start with the EPS Rulebook Showdown, then move to the objective of IND IS 37. From there, we'll cover defining provisions and liabilities, legal versus constructive obligations, corporate contingencies, and finally, onerous contracts and restructuring.
All right, Section 1, the EPS Rulebook Showdown. It's IND AS 33 versus AS 20.
When you look at the comparison here, the evolution in accounting rigor is just stark. Under the old AS20 rules, dealing with things like mandatorily convertible instruments or contingently returnable shares was kind of vague. There were no specific requirements, no real guidance. It was a bit like playing a sport without out-of-bounds lines. But in IS 33, it totally tightens the net. It demands explicit clarity. For instance, ordinary shares to be issued upon conversion of a mandatorily convertible instruments, they're included in basic EPS right from the contract date. Potential future dilutive instruments, you've got to disclose them even if they're anti-dilutive for the periods presented. And ordinary shares issuable solely after the passage of time, IND IS 33 says time is a certainty, so they are not treated as contingently issuable. Plus, contingently returnable shares are simply ignored in basic EPS until they can't be recalled anymore. It leaves literally no stone unturned.
Moving right along to Section 2, IND AS 37, the objective. We are officially entering the world of what-ifs.
For any analyst or investor out there, IND AS 37 is essentially your flashlight in the dark. The core objective here is absolutely crucial, ensuring that appropriate recognition criteria and measurement bases are applied to provisions, contingent liabilities, and contingent assets. It forces companies to provide sufficient note disclosures so users can actually understand the nature, the timing, and the exact amount of these uncertain items. Keep in mind, this standard applies universally, but it generally excludes executory contracts, unless, of course, those contracts happen to be onerous.
Section 3, defining provisions and liabilities. I like to call this the Russian nesting doll of accounting.
Now, what's really interesting about this concept is how it's layered. Let's start at the very top level with a provision. It's deceptively simple. A provision is a liability of uncertain timing or amount. Those two words, uncertain timing or uncertain amount, that's the key. That is exactly what separates a provision from your standard everyday accounts payable. So that naturally begs the question, what exactly is a liability in this context? Well, a liability is a present obligation of the entity arising from past events, where the settlement is expected to result in an outflow of resources embodying economic benefits. Notice the timeline we're working with here. The event happened in the past. The obligation is sitting right here in the present. And that outflow of cash or resources, that's going to hit in the future. And going one layer deeper, what actually triggers that liability? That would be the obligating event. This is the specific event that creates a legal or constructive obligation, which results in the entity having absolutely no realistic alternative but to settle it. Basically, it's the moment the company is backed into a corner and legally or ethically just has to pay up.
Section 4. Legal versus constructive obligations. Where exactly do these obligations come from?
So obligations essentially come in two distinct flavors. First, we have the legal obligation. This one is rigid and formal. It derives straight from a contract, whether explicit or implicit, or from legislation and other operations of law. Break this, and there are direct legal consequences. But then we have the constructive obligation, which is super fascinating. This derives purely from an entity's own actions. If a company has an established pattern of past practice, or they've published specific policies, they're signaling to other parties that they will accept certain responsibilities. By doing that, they create a valid expectation in the minds of others that they'll discharge those responsibilities. So even without a formal, written contract, their own behavior has locked them in.
Section 5. Understanding corporate contingencies. It's time to deal with uncertain future events.
Let's untangle this one, because a contingent liability can actually be one of two very distinct things. Condition A is basically a maybe obligation. It's a possible obligation arising from a past event, but its existence will only be confirmed by the occurrence or non-occurrence of uncertain future events that are not wholly within the company's control. Think of a pending lawsuit waiting on a judge's verdict. Condition B, though, is a real, present obligation from a past event, but it is not recognized on the books. Why? Either because it's just not probable that an outflow of economic resources will be required, or we simply cannot measure the amount reliably. We know it's a present obligation, we just can't put a firm number on it yet.
Now, let's briefly flip the script to the positive side. A contingent asset is practically the mirror image. It's a possible asset arising from past events whose existence will only be confirmed by uncertain future events outside the entity's complete control. But remember, accounting standards are inherently conservative. You don't recognize it in the statements because you don't want to count your chickens before they hatch, though you do have to consider it under the standards guidance.
Section 6. Onerous contracts and restructuring. What happens when things just don't go according to plan?
An onerous contract. Honestly, this is the ultimate bad deal. It is explicitly defined as a contract where the unavoidable costs of meeting your obligations actually exceed the economic benefits you expect to receive from it. It's that painful scenario where the absolute minimum cost to fulfill your end of the bargain is mathematically worse than whatever value you're getting out of it. The standard ensures we have to face and recognize these harsh realities.
And finally, we have restructuring. Now, this isn't just some casual change in day-to-day corporate strategy. It is strictly defined as a program that is meticulously planned and controlled by management. Crucially, it must materially change either the scope of the business undertaken by an entity or the manner in which that business is conducted. It's a deliberate, massive pivot. And provisioning for those costs requires strict adherence to all the rules we've just unpacked.
And this brilliantly illustrates our final thought. We've seen how IND AS 33 locks down exact calculations for earnings per share, completely removing the vagueness of AS 20, and how IND AS 37 forces companies to rigorously map out their uncertain provisions and contingencies. But it leaves us with a pretty provocative question. If the business landscape is inherently chaotic and the future is always uncertain, is your balance sheet ever truly secure, or is it just a perfectly educated estimate? Thank you so much for joining me on this deep dive in today's explainer, and as always, keep questioning the numbers.
Today, we're taking what can often feel like a really dense, highly technical accounting standard and turning it into a clear, logical playbook for handling financial uncertainties. Because let's face it, in business, the future is rarely a guarantee, right? Lawsuits pop up, environmental cleanups become mandatory, product warranties get claimed. So how exactly do we account for these unknowns today? Well, that's exactly what we're going to uncover.
Let's just dive right into the core issue here. It's the fundamental problem every accountant faces when the future is incredibly murky, but an expense is definitely looming. Look, if you know you owe exactly 10 grand next Tuesday, accounting for it is a breeze. But what if you know you owe money, but you aren't sure exactly how much or even when you'll have to pay it? If you just sweep it under the rug, your financial statements are painting this overly rosy, fake picture. But if you just guess wildly, you're actively misleading your investors. So we desperately need a structured mechanism to record these uncertainties accurately.
To figure this out,
We'll follow a pretty structured decision tree today. First, the nature of provisions. Second, provisions versus contingent liabilities. Third, the rules of recognition. Fourth, handling contingent assets. And finally, measuring the unknown.
Section 1. The nature of provisions. Let's establish our baseline and define what exactly sets a provision apart from your everyday run-of-the-mill expenses.
It essentially boils down to certainty. Everyday liabilities are pretty much a sure thing, whereas provisions are fundamentally defined by their uncertainty. When you buy raw materials on credit, you've got a trade payable, you have an invoice in hand, and the amount is set in stone. Accruals, like employee wages, also have super high certainty, and they often get grouped right in with trade payables. But provisions? They're for things like pending court cases where, yeah, you might have to pay damages, but the judge hasn't actually banged the gavel on the exact dollar amount yet. And because of that inherent uncertainty, provisions absolutely have to be reported completely separately on the balance sheet.
Moving to Section 2. Provisions versus contingent liabilities. This is where we hit a major fork in the road in accounting logic.
This distinction is absolutely crucial because it dictates whether a number actually hits your balance sheet or not. Provisions make it onto the balance sheet as recognized liabilities. Contingent liabilities do not. A provision is a present obligation where an outflow of your resources is probable, meaning it's highly likely to happen. A contingent liability, on the flip side, is just a possible obligation. Its actual existence is only going to be confirmed by some uncertain future event totally out of the company's control. Or it could be a present obligation, but the chance of actually having to pay up might just be too low to measure reliably.
Section 3. The rules of recognition. Because you can't just slap uncertain numbers onto the books without putting them through a really rigorous test first. Think of these rules like a strict bouncer at a club. If an entity fails to meet even a single one of these 3 conditions, no provision is recognized. Step 1. You need a present obligation from a past event. This could be legal, like a signed contract, or constructive, meaning your company created a valid expectation through its past actions, but it has to stem from a past event. You absolutely cannot recognize a provision for future operating losses. Step 2, the outflow of economic benefits has to be probable. And Step 3, you must be able to make a reliable estimate of the amount. If it fails any of those, it doesn't get in. It's not a provision.
Now, what's really interesting here is that even if an item fails the test and isn't recognized as a provision, you can't just ignore a contingent liability. It still has to be disclosed in the notes unless the risk of an outflow is practically zero, like completely remote. You have to describe it and try to estimate its financial effect. Oh, and if a company is jointly and severally liable with others for an obligation, the part the other guys are expected to pay is treated as a contingent liability, while your probable chunk is recognized as a provision. The standard demands absolute transparency for anyone reading those financial reports.
And hey, things change, right? Because expectations shift. Companies have to continually reassess these items to see if they need an upgrade to a recognized provision. Think about a lawsuit that looked like a minor nuisance last year, a classic contingent liability. Well, maybe due to a crazy new court ruling, it suddenly looks like a guaranteed massive loss this year. The exact moment that outflow becomes probable and measurable, it leaps out of the disclosure notes and straight onto the balance sheet as a provision for that current period.
Section 4. Handling contingent assets. Let's flip the script for a second. What happens when a company expects an uncertain inflow of money?
Well, accounting standards are inherently conservative. You absolutely cannot recognize a contingent asset on the balance sheet. These usually pop up from unplanned or unexpected events, like if you're suing a rival company for damages. But we can't just put potential winnings on the books early. Why? Because that could lead investors to believe the company has locked in income that might never actually materialize. You can disclose it if the inflow is probable, but you can't officially recognize it.
This setup perfectly summarizes the entire decision tree, and it highlights a really huge asymmetry in accounting. Prudence dictates that we treat potential losses way more aggressively than potential gains. If an outflow or loss is probable, boom, you recognize a provision immediately. But if an inflow or gain is probable, you only get to disclose it. You cannot actually recognize a contingent asset until realizing that income is virtually certain. It's a fantastic cheat sheet for navigating all this financial uncertainty safely.
Section 5. Measuring the unknown. So once an item finally passes the strict recognition test, how do we actually put a reliable number on it?
There are strict measurement rules to ensure the amount you recognize is the absolute best estimate of what you'd need to settle the obligation today at the end of the reporting period. First, it's always measured before tax.
Second, if the settlement is way off in the future, say a massive environmental cleanup 10 years down the road, you have to account for the time value of money. You discount those expected future cash flows back to their present value using a pre-tax discount rate. And finally, you definitely have to consider any new events or evidence that pop up after the balance sheet date but before the statements are approved.
For large populations of items, companies rely on statistics rather than just guessing a single number. A classic example is warranty provisions. If you sell 1 million TVs, you don't know exactly which ones are going to break, so you use an expected value calculation based on probabilities. If historical data shows a 75% chance of zero repair costs, 20% for minor costs, and a 5% chance of major replacements, you calculate the weighted average of all those possible outcomes. That statistical expected value becomes your rock-solid provision amount.
Here's a huge rule. You cannot artificially lower your provision by subtracting potential future profits from selling off an asset. Let's say you're restructuring, shutting down a division, and you have a massive provision for severance pay. But hey, you also plan to sell the old factory building at a big profit. You are strictly forbidden from netting those two numbers together. The restructuring provision has to be recognized in full, and the gain on the factory sale, that's only recognized later when the factory is actually sold. You have to keep them totally separate.
Now, what about future events? You can definitely factor in logical, proven technological improvements for things like site cleanups, provided you have objective evidence. But you cannot rely on science fiction. You can't assume a completely brand new, uninvented technology will suddenly exist to slash your costs. Also, if you're calculating a restructuring provision, you can only include direct expenditures. That means absolutely no throwing in the costs of retraining your remaining staff, relocating them, or marketing a new brand image. Those are just normal, ongoing business costs, not restructuring liabilities.
I'll leave you with this provocative thought to show just how dynamic the world of financial accounting truly is. A company's balance sheet is not some static snapshot of perfect certainties. It is a living, breathing document that has to constantly react as new information turns remote possibilities into probable realities. Understanding these precise rules behind provisions and contingent liabilities literally gives you X-ray vision into the true health and the hidden risks of any organization. Thanks for tuning into this explainer. Keep questioning those numbers, and we'll see you next time.